Hello friends, my name is Masood. Today we shall discuss about a topic, the return on investment or ROI. Friend, this is a very important and interesting topic, especially if you are studying project management or you're studying business management. So this is a very important topic, and you will see definitely this topic in the exam. First of all, secondly, if you are a person dealing or working in any organization as a project manager or as a business manager, so again this is an important topic. You must have to know about this topic, that how we can use this topic in the practical life of professional life. So let's start, friend. First of all, I would request to please subscribe to my YouTube channel and click on the bell option as well, so that my new videos can reach to you. So let's start. A return on investment. Friend, first we have to understand that what is basically the concept of return on investment, ROI. Basically, whenever we are initiating any project or we are measuring the performance of any project, so we use the concept or methodology of return on investment. Return on investment is basically a concept of project selection methodology. Whenever we have to decide, for example, you have three projects you can initiate in any organization. Okay, so you can use this method on return on investment, so that you can analyze that if you invest, for example, $5,000 you are investing. So after 1 year, which project will give you more return on investment? Return means in general and simply means that what how much profit you will get after the investment. Like for example, if one project, like you are investing $5,000 and one project is giving you $500 as a return, one is $1,000 and one is $1,500. So obviously the project who is giving you more return in on investment, so that means you definitely have to adopt, you definitely have to go for that project. Okay, so that is basically the concept of return on investment. If you just see this term, return on investment, that how much is returning means the profit. Okay, it basically generally it is referring you the profit, that how much profit you will get on the investment after few months or after 1 year or 2 year. Okay, so return on investment, ROI, is a performance measurement used to evaluate the efficiency or profitability of an investment or compare the efficiency of a number of different investments. ROI tries to directly measure the amount of return on a particular investment relative to the investment's cost. To calculate ROI, the benefit or profit of an investment is divided by the cost of the investment. The result is expressed as a percentage or a ratio. Okay, so simply, for example, if you what profit divide by the cost of investment, yeah, the return result will be expressed as a ratio or percentage. For example, you have invested $5,000 and you have received the profit benefit as $1,000, for example. So what you will do, 1,000 divided by 5,000, and answer will be represented as a percentage or a ratio. Okay, so that is the main concept, that is the main formula of return on investment or ROI. Now, return on investment, ROI, is a popular profitability matrix used to evaluate how well an investment has performed. Okay, first of all, it is a matrix, it is a measurement matrix actually. ROI is expressed as a percentage and is calculated by dividing investment net profit or loss by its initial cost or outlay. ROI can be used to make apple to apple comparisons and rank investment in different projects or assets. ROI does not take into account the holding period or passage of time, and so it can miss opportunity cost of investing elsewhere. Okay, this is an important point, that return on investment, basically it is not taking considering the account the period or passage of time. It's so it can miss the opportunity cost. Opportunity cost may basically, remember friend, that opportunity cost means that if you lose any project, so what will be the cost? For example, what will be the cost if you lose the ABC project? ABC project, if you lose, how much cost you will lose actually? How much profit you will lose actually? That is the basically the cost concept of opportunity cost. Here just want to give you a simple example. For example, suppose you ABC person invested $1,000 in any or a multinational corporation and sold the share for a total of $1,200 1 year later. To calculate the return on this investment, divide the net profit 1200 minus 1000, it is 200, by the investment cost 1000 for our ROI of, so 200 divided by 1000 or 20%. So 20% is your ROI, return on investment. Again we can let me give you an example, try to explain the example. $1000 you have invested. Okay, so this is the total investment. You get the total revenue, total you sold it for a total sale was 1200. So 1200 minus $1000, it is 200. So 200 divided by 1000, it is the 20%. 20% is the ROI, return on investment. Okay, so what is the basically formula is the profit in benefit minus benefit divided by the investment, so it will give you the percentage answer or ratio answer. It is the ROI or return on investment. It is the formula to calculate the return on investment. How to with this formula one could compare the investment inside. Okay, and another point is that take the same example, like for another example, yeah, another person has invested $2000 in any other store in 2014 and sold the share for a total of 2800 in 2017. The ROI in big sale would be 800 divided by 2000, it is 40%. So you can compare the ROI of this one with the previous one as well. Okay, here remember that ROI is a very good methodology to for comparison. That, like for example, previously you are getting in that project you are getting 20% ROI, return on investment. Like you, if you are investing $1000, you are getting 20% raise or 20% return. Here in that project you are investing, on your investment you are getting 40% return on investment. Okay, so that definitely this project is much better than the than that one. Why? Because you are getting more return on investment here. Okay, so this is a very good methodology as well for comparison. So ROI calculations are simple and help an investor decide whether that to take or skip an investment opportunity. The calculation can also be an indication of how an investment has performed to date. When investment shows a positive or negative ROI, it can be an important indication to the investor about the value of the investment. Using ROI formula, an investor can separate low performing investments from high performing investment. With this approach, investors and portfolio managers can attempt to optimize their investments. So friend, thanks a lot for watching the video. I hope you like this video. If you like, please share it with your friends and colleagues, and thanks for watching the video. Thank you.